If you're getting a late start on your retirement, you're probably feeling the heavy pressure to catch up. But going all in on the standard S&P 500 right now could be the biggest mistake you make. Welcome to FactorDad. Today, we're unlocking the factored advantage and kicking off our Factor 4 portfolio series with a deep dive into a secret weapon most mainstream investors are completely ignoring: AVDV. Let's look at the markets today. When the broad US market takes a massive hit, dragging countless retirement accounts down, AVDV holders barely flinch. Why? Because international small-cap value dances to its own beat. It acts as the perfect shock absorber for a retirement portfolio that can't afford a lost decade. So what exactly is it? AVDV is the Avantis International Small Cap Value ETF. Instead of buying massive, overpriced companies, it targets two things: the quote-quote size premium by buying smaller, agile companies, and the quote-quote value premium by buying cheap, overlooked stocks. But it's what they do next that makes the real difference. Here is the Avantis edge. Traditional value funds just buy cheap companies. The problem is, some companies are cheap because their businesses are literally dying. That's a value trap. AVDV acts as strict quality control. They heavily screen for profitability, ensuring you only buy cheap companies that are financially healthy and making real money. If you are a professional beginner investor or a late starter, you face the ultimate catch-up problem. You need serious growth, but you absolutely cannot risk massive crashes. By utilizing factor premiums, AVDV historically offers higher expected returns while moving your money away from US megacaps, protecting you from sequence of returns risk. And the results speak for themselves. Look at the incredible momentum here. As of late February 2026, AVDV is up an explosive 65.98% over the past year. Even year-to-date, it's already up over 16.5%. This is a masterclass in international value realization, and it's happening entirely outside of the US market. To really understand why this works, we have to look under the hood. Your top three sectors are heavy industry, industrials at roughly 22%, materials at 21%, and financials at 14%. Geographically, you are getting massive exposure to highly stable, developed economies like Japan at 32%, followed by Canada and the United Kingdom. Notice what's missing here. There is almost zero tech. That is by design. Tech companies are generally priced as growth stocks. AVDV, on the other hand, leans heavily into tangible assets and heavy industry. If your portfolio is already stuffed with US tech, AVDV creates the perfect counterbalance. Remember, when you buy this ETF, you aren't just buying paper. You are buying real businesses. Top holdings include global mining giants in Japan and Australia, and energy resources in Canada. It is deeply diversified, giving you a slice of over 1,500 individual companies holding the global economy's real assets. Now, let's talk about the price of admission. The expense ratio is incredibly low at just 0.36%, which is exceptionally cheap for an active international fund. And as a cherry on top, it throws off a very healthy dividend, currently between 2.6% and 3.4%. You literally get paid while you wait for the value premium to show up. But we keep it real here. There are risks to unlocking these premiums. First is tracking error. Second is currency risk. And third is volatility. It's small cap, so it will swing wildly. Because of this, I have a strict FactorDad rule. Do not buy this ETF unless you are committing to a minimum 10-year holding period. Let's break down that tracking error. There will be the pain of deviation, long stretches where you underperform the S&P 500. The psychological toll of seeing US markets soar while your international allocation lags is real. But the payoff of patience is that when US tech finally corrects, AVDV acts as your portfolio's shock absorber. You also need to understand currency risk. AVDV is unhedged. If the US dollar gets stronger, it acts as a headwind and your returns drop. But if the US dollar weakens, you get a massive tailwind. Think of it as a natural hedge against the decline of the US dollar. So how do you actually use this? AVDV is a satellite holding, not your core. For late starters catching up, a 10% to 20% allocation is the sweet spot. It pairs perfectly with a broad US total market fund, but make sure you aren't overlapping it with other international small-cap funds you might already own. The verdict? AVDV isn't just a stock pick, it is a core pillar of the Factor 4 portfolio. It provides the exact catch-up engine late starters need to accelerate their wealth responsibly. In our next video, I'm unveiling Factor Fund number 2. Hit that subscribe button right now so you don't miss it, and I'll see you in the next one.